Hi everyone, we are now going to be reviewing two of the problems at the end of Chapter 5, the first being 534A and then 536A. Now, we have changed our direction. For the past couple chapters, the first 4 chapters, as a matter of fact, we focused on a service business and the accounting cycle, introducing you to this whole concept of the accounting cycle. It's really the backbone of accounting for any company. These are all the steps that need to be accomplished in a year to properly report accounting information. Well, now that you understand and have learned the accounting cycle, we can now start looking at a different type of company, a merchandiser, and that's what this chapter focuses on. So the thing to keep in mind is that a merchandiser still has an accounting cycle. They do all the things we did in chapters 1 through 4. But instead of redoing all those items again, we're just going to introduce you and show you the unique things that a merchandiser does that a service business doesn't. And that's purchase and sell inventory. That is how they make their revenue. So you should have listened to all of the voice lecture and gain an understanding of a merchandiser. And now we're attempting the homework. So, of course, a merchandiser will make journal entries just like a service company does. So we're looking at Aquamarines. They purchase finished goods from a suppliers and then they resell them. They don't tell us what goods, but we can make something up, right? Aquamarines estimate sales returns at the end of each month, and that was discussed in the chapter. So now let's see what kind of transactions Aquamarine has and how we journalize them. September 3rd, the company purchased merchandise inventory on account from Sharpener wholesalers, $5,500. So as you can see in front of you, the journal entry would be to debit the merchandise inventory account, which is an asset account, and that is where we store the cost of all the inventory we buy, and it remains there until we sell it. And we credit accounts payable. Notice there's terms 215 and EOM. These are cash discount terms. The first number represents a percentage discount, so a 2% discount is being offered to Aquamarines, us, if it's paid in the first 15 days. If it's not paid in the first 15 days, it's due by the end of the month. So you're giving credit terms when you don't pay for your merchandise the day you buy it. So you'll always be crediting accounts payable when you see a credit terms. FOB shipping point defines who owns the merchandise while it's being shipped. They're the ones responsible not only for the merchandise, but also the shipping costs. And when it's FOB shipping point, the buyer is the one who owns them. So Aquamarine is the buyer in this case, so they own the goods while they're being shipped. In the next transaction, Aquamarines paid freight bill of $85 on that last purchase. We are doing and completing the journal entries in a perpetual inventory system. A perpetual inventory system. That means we change the inventory account with a journal entry whenever we buy or we sell inventory. It also means that any cost, anything we have to pay for to get the merchandise to our shelves should be debited to the inventory account, and that includes freight charges. So when they pay for these freight charges to get the inventory to our store, debit merchandise inventory, credit cash. Now, if you're sitting there going, that should be an expense, not the day it's paid. That will eventually become an expense when that merchandise is sold, and you'll be seeing that in a few transactions. September 4th, they purchased more inventory for cash of $1,600. Well, here they're paying for it, so debit merchandise inventory, credit cash. The 6th, Now they're going to return $1,300 of the inventory that they purchased from Sharpener. Now remember, up in the September 3rd journal entry, they haven't paid for the Sharpener purchase yet. So when they returned $1,300 of the goods, debit accounts payable. They'll decrease the amount they owe and decrease inventory. So far, these first 4 transactions are typical transactions when a company is purchasing inventory. Now we're going to look and see what happens when they sell inventory, because there's 2 distinct things we need to record. Let's take a look. Sold merchandise inventory to Herman Company, $5,700 on account. Terms, $215 and $35. The cost of these goods, $25.65. So now Aquamarine has a customer come in and they sell them $5,700 of goods. That's the selling price to Aquamarine's customer. That's what Aquamarine is charging their customer. This is the way Aquamarine makes money. This is their business. They provide a product. So the first thing we have to do is record the sales revenue related to this. Now, we have a little snafu here. We just don't debit accounts receivable and credit sales revenue for the full amount. Why? Because Aquamarine is offering Herman, their customer, a sales discount. What they're saying is, Herman, pay your bill to 15, pay your bill in the first 15 days, and you don't have to pay us 2% of it. So now Aquamarine is offering a cash discount to their customer. Pay your bill early, take 2% off of it. Well, the accounting rules say when you have this kind of scenario, you assume the customer will take the discount. So we assume that the customer, Herman, will pay their bill early. So on the day of the sale, deduct the sales discount before you even record this journal entry. So take 5,700 minus 140, or 114, I'm sorry, 114. So debit accounts receivable for $55.86, credit sales revenue. We only do this when it's the customer that we sold to, and we offer them a discount if they pay early. That's the first thing. The next thing we have to do is reduce our inventory account for how much the stuff we sold originally cost Aquamarine. It cost us $25.65, credit merchandise inventory. What do we debit? An expense account. And this expense account is called cost of goods sold. And that's exactly what's in this account, the cost of any goods that are sold. So when we buy inventory and we own it, it's an asset. When we sell it, it's now an expense of our business. And that's why we take it out of the asset category by crediting it and debiting the expense. So you'll actually have 2 journal entries whenever you have a sale. 9. Purchase merchandise inventory on account from Tucker Wholesalers, $6,000. So now it's Aquamarine's purchasing. Tucker offers us credit terms 310, net 30, so that means we get a 3% discount if we paid in the first 10 days. If not, we pay it by the 30th day. And these are shipped FOB destination. So Tucker, the seller, owns the goods while they're being shipped, because the seller owns the goods if it's being shipped FOB destination. Now, when we're buying and we're being offered credit terms, we record the merchandise inventory at the full amount and credit accounts payable for the full amount. We'll show you what happens if we do take the discount. On the 10th, we made payment to Sharpener. Now, Sharpener is the one we bought up on the September 3rd. Remember up here, We credited accounts payable for $5,500, but then on the 6th, remember, we debited for $1,300. So we only owe $4,200. So we're going to debit accounts payable for the $4,200. But we're paying within the discount period. We're paying in the first 15 days. So we don't have to pay the full $4,200 in cash. We could deduct 2% of $4,200 or $84. So our cash that we'll pay and we'll credit $4,116. The $84 purchase discount is credited to merchandise inventory. Remember what's in the merchandise inventory account: the cost to get the asset ready to sell. Well, when we originally bought this inventory, we thought we would be paying full price. We didn't. We paid $84 less. So credit the merchandise inventory account for that discount. The 12th, received payment from Herman Company less the discount. So let's take a look. Here's Herman Company. Remember, when our customer buys off of us and we offer them a discount, we assume they'll pay us early and take the discount, and we record the accounts receivable at the discounted amount. So when the customer pays us within the discount period, debit cash, credit accounts receivable for the $55.86. The 13th, after negotiations, received a $500 allowance from Tucker Wholesalers. Well, you could see the resulting journal entry, but let's make sure we understand what an allowance is. Sometimes companies will send to Aquamarines here. Tucker sent products to Aquamarines. Aquamarines got the products, recorded that they received them. But then as they were going through and putting them on the shelves and all of that stuff, they noticed some of this stuff wasn't the right color, or maybe it was a little damaged. Still sellable, but a little damaged. So they called Tucker and they say, we could do one of two things here. We could send you the stuff back, or we'll keep it and you take a little bit off of the amount we owe you. Well, in this case, Tucker agreed and gave them a $500 allowance on what they owed, or a reduction in the price of that inventory. So we handle it the same as if we were returning it for purposes of our accounting records, because really we're just paying $500 less for that inventory. So debit accounts payable Tucker, credit inventory. And I'm sorry, there is that journal entry highlighted. So that's how you handle an allowance. Let's look at the 15th. Aquamarine sold inventory to Jerome Company, $2,800. That's the selling price. That's what they charged their customer, Jerome, on account. Terms net end of month. So no discount is being offered. So there you go. Debit accounts receivable, $2,800. Credit sales revenue, $2,800. The cost of those goods was $1,200. Again, we have to decrease the inventory account by crediting merchandise inventory and debiting the expense account, cost of goods sold. On the 22nd, Aquamarines paid Tucker Wholesalers for the goods purchased on September 9th. Now take a look. On September 9th, and you could look at in your book, they purchased goods and were offered a discount if they paid in the first 10 days. Well, on the 13th, they received an allowance, so they don't owe the $6,000 anymore. They only owe $500. But in order to get the discount, they needed to pay the bill by the 19th. They didn't. So this just demonstrates that if you're paying the bill past that discount period, debit accounts payable for the amount you owe and pay the amount you owe, $5,500. On the 23rd, Jerome Company returned $200 of the merchandise sold on September 15th. The cost of the goods was $80. Now, in accounting, and you read this in your chapter, at the end of each month, a company estimates returns that will occur from this month's sales in the future. And I'm going to take you back to page, so you could see this, because they don't demonstrate it in this problem. On page 282. On page 282, the very last transaction, you'll see it says debit sales revenue, credit refunds payable. Not because anybody returned anything, no. In accounting, what we do at the end of each month is, and some companies do it, some companies don't, but usually they do, we estimate future returns. And instead of waiting till the return comes back to debit sales revenue, so that we have a true figure of what we really think we sold for the month, we try to estimate what will probably come back from this month's sale and debit sales revenue now. So this is not what our transaction is doing here. I'm just showing you that last month we estimated for this to come back. It's not in our journal entries here, but they told us they did in the instructions. And that was the journal entry they made. The company said, we expect so much of our sales to come back in the future, so let's debit sales revenue now, and we'll store the amount we expect we're going to have to pay in a liability account called refunds payable. Well, what's happening on our journal entry here? Someone actually returned something. Jerome did. Jerome returned stuff that we charged them $200 for. So when you have an actual return from a customer, you debit that refunds payable and either credit cash or, in this case, accounts receivable. So that's the first part. So we estimated at the end of last month. That's why we have this journal entry now. Not only did we estimate and record the effect on sales revenue for stuff that'll come back next month, we also did the same thing for inventory. So what does this mean? Well, if we're going to get stuff back that we sold, some of the stuff we sold should not be in cost of goods sold. So we're going to decrease the cost of any goods we think are coming back, and we debit, not inventory, because they actually didn't come back. We store that estimate in an estimated returns inventory account. It's an asset. We kind of let it sit there. Then, like on September 23rd, when these goods come back, now we could debit inventory and we credit the estimated returns inventory account. So what you see on page 282 is the estimate that causes us to record an actual return the following month, as we just did. The 25th, sold merchandise inventory to small for $1,800 on account that cost $738. The terms are $310, net $30 was offered, FOB shipping point. Also, as a courtesy to small, the customer, $40 of freight was added to the invoice, for which was paid by Aquamarines. Now remember, these goods are being shipped FOB shipping point, so small is responsible. That is their expense. But what we did over at Aquamarines is we paid them for them. Now, that doesn't mean that's our expense. That means not only does small owe us for the merchandise, but also the freight bill. So we'll credit cash when we pay it. We credit sales revenue. Remember, when we sell to a customer and offer them a discount, we record the revenue as if they're going to take the discount. So $1,800 times 3% or $54 is subtracted from the cost of the merchandise. You do not take a discount on the freight bill, just the merchandise. Those two together is the total amount small owes. So debit accounts receivable for the $1,786. Don't forget to debit cost of goods sold and credit the merchandise inventory for the cost of those goods. Remember, cost of goods sold is an expense account. The 29th, received payment from Small less the discount. Well, how much did Small owe us? Even less the discount, $17.86. So debit cash, credit accounts receivable, $17.86. And then in the final transaction, on the 30th, received payment from Jerome Company less the return. Now, we didn't offer any kind of discount to Jerome, but we know when we sold to them, we debited accounts receivable up here. And then when they returned some stuff, they owed us $200 less. So we'll debit cash and credit accounts receivable. Now, let me see if I can modify this a little bit without it getting too upset with me. Insert below. Okay, let's pretend something. Let's pretend that Small didn't pay their bill in the discount time. So I'm going to put that as an assumption. Hold on one second, I'm losing my, there we go. Okay. Assume that Small instead paid their bill October 15th. Okay, so they did pay their bill correctly here, but now we're just going to assume, no, they paid it October 15th. Well, remember, Small needs to pay within the discount period, which was 10 days. That bill should have been paid by October 5th, but it's not. So what happens? Well, they don't get the discount. So Aquamarines will be receiving cash for $1,840. The full amount of the bill, $1,800, plus that freight. Don't forget about that freight, right? Let me add some more things down here. Okay. All right. So debit cash. We can only credit accounts receivable for the amount we originally debited it for, the $17.46, or $17.86, sorry. Still need to credit something for $54, and we credit a revenue account called sales discount forfeited. And it is a revenue account. That's why it doesn't have the word revenue in it, but it is a revenue account. And we credit it just like a revenue when it increases. And it is reported on the income statement. And we'll show you where it's reported when we go through the income statement. Okay, so I just wanted to demonstrate, since they didn't have that in here, what happens if a customer fails to take a discount. Okay, so that is problem 534A, focusing on the typical journal entries you see in a merchandising company, different than a service company. Now, the next problem I want to review with you is P536A. I apologize for this because I'm monkeying around here. There we go. Let's see if I... All right. In P536A, they ask us to create this new income statement format that was introduced in Chapter 5 called the multiple step. And it's called multiple step because you calculate items in steps. Now, an income statement is an income statement. You're going to report your revenues and expenses here. We always start with our heading, the same as before. But now, instead of just listing revenues, expenses, net income, the first thing we do is our first major calculation, and that is gross profit. So we will list our net sales revenue. That's the only revenue item that we put first. So we take the sales revenue off of our adjusted trial balance there on page 304 and list it. We then subtract the major expense of a merchandiser, which is cost of goods sold. So remember what's in these accounts. Sales revenue has the revenue we charged our customers, the sale price we charged our customers for stuff we sold. What's cost of goods sold? The amount the stuff cost us. So if we're selling CDs, we sold and charged our customers $184,000 for CDs, compact discs, but those compact discs cost the company, Rachel Ray Company, $85,500. So the profit from just selling the product, gross profit, $98,500. First computation. The next computation is operating income. After we determine gross profit, we then will list our operating expenses. Now, operating expenses are the majority of your expenses. These are amounts we must pay to run the company day in and day out, directly related to selling our product and providing services for our product. The two major subcategories are selling and administrative. Selling expenses generally relate directly to selling, advertising, commission of the salespeople, the storefront, depreciation on the equipment inside the store where you display your compact discs. Administrative expenses are also necessary for operation of our business, but they're not directly selling the product, people in these positions. This is your office staff. So you could have your copy machine expense here, your supplies, office supplies, salaries for the administrative assistant or the president. Okay, those are your typical type of expenses there. Both required to run our business day in and day out, but on different sides of the business. So we separate those expenses and we total them. Total operating expenses, $30,600. We then subtract them from gross profit to get our operating income. Now, operating income is described as income from purely operating your business. If you had no other revenues and expenses, that would be net income. But sometimes we do have other revenues or incomes and expenses. We will list them separately after operating income. Now, a typical expense that is not considered operating is interest expense. Interest is not a necessary expense to run your business. It's a necessary expense of financing your business, which is different. Interest revenue. Sometimes we earn interest on our investments. Well, that's not part of running our business day in and day out. That's a revenue from investing in our business. So if revenues and expenses originate from investing or financing activities, they're usually listed in this area and either added or subtracted. Now, a lot of people say, why is there parentheses around expenses? I didn't think we had to do that. Well, in this section you do, because you may have income items as well. You put both types of items in this section. So because we have that, we want to make sure we accent the expenses with parentheses or minus sign. So we'll list our interest expense. That's the only other item that needs to be listed on our income statement from our adjusted trial balance, subtracted to get our last and final number, net income. So we still are calculating net income. We're just doing it in steps now. And at each step, we're providing information, important information to decision makers. So I know a lot of people will say at this point, I like the old income statement better. And I say, I do too. But it's not about making our life easy. It's about providing good information to decision makers. Okay, so that's the income statement. Now, in this problem, they ask us to do the closing journal entries for Rachel Ray's company. And this is a great review of Chapter 4. And it's also used to demonstrate we really do closing journal entries even at a merchandiser. It's part of their accounting cycle. So your first closing journal entry, debit sales revenue, credit income summary for the balance, just like before. Before it was service, now we call it sales. And our second, reset all the expenses to zero. Don't forget to reset cost of goods sold. That's also an expense. And here's how you can look at it. if an account appears on your income statement, reset it to 0. So credit cost of goods sold for its balance, credit selling and administrative expenses for their balances, as well as interest expense. Add those up, debit the income summary 118. Now find the balance in your income summary account. It will be a credit of $66,000. And I know it will because net income is $66,000. So now reset the income summary to 0 by debiting it and transferring the net income into Ray's capital account by crediting it. The final journal entry is to reset withdrawals to 0 by crediting withdrawals and debiting the capital. So if you take a timeout right now and create a T account just for Ray's capital. Ray's capital, according to the adjusted trial balance, has a $27,350 balance. But during closing, we credit it for $66,000 and we debit it for $40,000. And if I'm doing my math right, it looks like it should have a credit balance of $53,350. How do I know? Well, it is because the very final item they ask us to do is a post-closing trial balance. Remember, that's our final trial balance after posting our closing journal entries. If we post all of the closing journal entries we just did, all the revenues would be 0, withdrawals would be 0, expenses would be 0, and the income summary account would be 0. Capital would have a credit balance of $53,350, and everything listed there before capital, your assets and liabilities, have the same balance. So list the assets with their balances, list the liabilities, and then list and record the updated capital balance after closing journal entries. Debits must equal credits. And the other day I was teaching this, and actually we were on chapters 5 or 6 in another school, and they said, yeah, I don't really like chapter 4. It wasn't too much fun. It seemed like we just wrote the same stuff down over and over. And I remember learning this and thinking the same thing. Why do we have to keep writing this down? But that's how it is in accounting in a manual system. Every opportunity we have to prove debits equal credits, we do it. And if we could prove before we start the next accounting year, everything's copacetic and ready to rock and roll, we do it. And that's why we have this post-closing trial balance. Now, of course, you know, we don't necessarily use manual accounting. Actually, I've never done manual accounting outside the classroom. I've always used some kind of computer software. So a lot of these steps, we don't do manually. We hit a button or select a drop-down box to have those items accomplish our goal. So that is our review of these 2 practice problems. So please try them on your own, go through these, ask any questions that you may have.